My name is Dean Russo. I'm a senior wealth advisor with Cutler Investment Group based in our Jacksonville, Oregon office. We have offices in Anchorage, Alaska, Bellevue, Washington, and Newport Beach. Well, we made it to the last quarter of the year. There's approximately 90 days left. This is your last chance to prepare for April tax reporting. We take this opportunity with our clients to make sure we are being as tax efficient as possible. Typically, people focus on portfolio performance when evaluating management. Performance is certainly important, but what we do now to reduce your tax burden can increase your personal returns. Other tools we will be utilizing are financial, estate, and distribution planning software like Listaplan. This is a great time of year to focus on your plans and goals. Now let's look at how much time we have left to work in. This year, there are 92 days in the fourth quarter. Of those days, I would argue that 17 of them are taken up with the holidays, specifically Thanksgiving, Christmas, and New Year weeks. They tend to be timeframes where not a lot gets done. We're traveling, we're planning, we're visiting, and enjoying the holiday experience. That leaves us with about 75 days. Of those days, only 53 are business days to get work done. The clock's ticking. Here are some of the topics of discussion we're having with clients. Required minimum distributions, or RMDs, qualified charitable distributions, or QCDs, Roth conversions, rebalancing of your portfolio, and setting appointments with your team. We'll dive into each one of these points in the following slides. Let's talk first about RMDs. If you turn 73 in this calendar year, the government will require you to make a distribution from your tax-deferred account each year moving forward. These are known as RMDs. Tax-deferred accounts are traditional IRA accounts, 401k, SEP IRAs, and other retirement plans that were funded with pre-tax dollars. The government allowed you to place pre-tax dollars in these accounts and let them grow tax-deferred over the years, and now the government wants to start collecting their taxes on these assets. You can take these distributions in cash, stock, mutual funds, ETFs, or bonds, or some combination of these. Once RMDs are calculated, you must distribute, meaning taking the funds and moving them from your IRA to your taxable account like a brokerage account, checking, or savings account. Any distribution is considered ordinary income, and you'll need to pay tax on that amount. Well, what happens if you don't take the RMD before December 31st? Along with paying income tax on that distribution, you will also pay a 25% penalty for failing to have completed the distribution before the end of the year. No one likes to pay more in taxes. That's why I typically encourage clients to have these completely done by mid-November. There are many ways to process the RMDs. Funds can be electronically sent from your IRA to your taxable account. You can request a check to be sent. And some financial institutions will allow you to have checking features for you to write checks from your IRA. Better to get these done early and avoid the penalty. You can also have tax withheld from the distribution to prepay the tax on the income. In doing so, some of the distribution will then need to be in cash. On the next slide, we'll discuss options you have to reduce your taxable income from RMDs. This strategy is called Qualified Charitable Distribution, or QCDs. Let me walk you through how they can work. As an example, if you have a $20,000 RMD and you take $10,000 in cash, but distribute $10,000 via QCD, you'll only have to pay income tax on the $10,000 you deposited into your taxable account, and you will have satisfied the RMD for the year. QCDs will go directly from your tax-deferred account to the charitable organization to qualify. This can be done via check sent out by your brokerage firm, electronic transfer, or check writing features if your brokerage firm allows it. There's no limit to the number of charities that receive the funds, only that they are a 501c3 organization and the RMD has been met. It is important to give the charitable organization time to cash your check. If they don't cash a check prior to the end of the year, any amount that does not get distributed in 2025 will be posted the following year and subject to the 25% penalty. Some charities close for the last week of the year. Like you, They have a lot to do for the holidays with family and friends. Don't wait too long to get them the gift. Mid-November is the target for my clients. On a side note, you're allowed to distribute up to $108,000 in QCDs in 2025. Also, you don't have to wait till 73. You can start this at 70 and a half if you'd like. There are a number of reasons to do this. One of the larger reasons is to reduce income tax in the future. We can evaluate the need, help develop a plan and strategy to meet your specific goals. Did you have less income this year? Do you have deductions that can offset income tax? This is a great opportunity to talk about Roth conversions. If your answer is yes to either of these questions, a Roth conversion plan and strategy may make sense for you. Taking funds from your tax-deferred account and converting them to a Roth account is a taxable event. However, if you're in a lower tax bracket, we can maximize the current tax bracket for the year, or if you have deductions to offset the income, developing a Roth conversion plan for the year and subsequent years is very important. All with the idea of reducing tax in the future and utilizing the Roth as a tool to distribute wealth. With this strategy, we'll want to evaluate your current income, project future tax implications, and review your estate plan. We can create a roadmap specific to your needs and goals through Holistic Plan. Planning is important, and we do not want to drastically impact current benefits via income-related monthly adjustment amounts or IRMA. This could also lead to higher taxes. As you can see, there is a lot to discuss, and we have not even begun to discuss your tax exposure or rebalancing in your brokerage accounts. After 3 years of solid gains in the stock market, your portfolio may now be more aggressive than you're comfortable with. Because the corrections are inevitable in the market, this is a good time to review the balance of your accounts, rebalance if needed, in the most tax-efficient way. Are there realized gains from property sales or business sales? We may be able to reduce the tax impact of these gains with tax loss harvesting or gifting strategies of highly appreciated stock. Mutual funds typically will distribute gains in November and December. After the last few years of nice returns in the market, more than likely they're going to pass through those gains to you in a short amount of time to be able to match up with any losses. We will evaluate those funds and also look for losses to match up with the gains that they will distribute. Another way to reduce down on the income tax you would pay are donor advised funds. They provide a unique opportunity to gift stock or cash now, receiving the charitable tax credit for this year, but allowing you years to distribute the funds. These can help reduce the tax impact of realized capital gains from those sales of either businesses or property, and even capital gains. It should be clear that you have many options to consider. We have planning tools like Holistic Plan that can help you with building strategies that can reduce the tax impact and increase your overall return. Everyone likes to pay less in taxes. This is the way to do it. Developing a plan and strategy is what we do to increase your overall returns. Okay, so there's a lot going on. Who should be involved in the last quarter of the year? Certainly your tax professional or CPA, your estate planning attorney, insurance agents to make sure the coverage is proper for the new year, and then start with your wealth advisor. Call Cutler for a plan and strategy. That's what we do. For additional information or to review your current plan with one of our professionals, give us a call as soon as possible. Time is running out.